Take it away, Ashton.
Okay, so we do a couple of these continuing educations for you guys. Happy to be here and get to be a part of everything. This is kind of the basic introduction. I'm sure that everybody here has been through enough transactions that you know a little bit about this. So this is going to be kind of the short and sweet version. We can dive in a little bit more with detail if you have questions throughout. Don't hesitate to raise your hand or speak up if any questions pop up. But yeah, this is just kind of what everybody needs to know about financing. Like I said, very general, very basic. We can go to the next slide. All right. And apologies to Michael because I couldn't find his face when I was updating this. With our new branding and everything, we have new email addresses. Michael will be michael.huggins@selectlendingservices.com. Same phone number. So we are all here to help you out if you have any questions or concerns throughout any transaction that you come across, any potential transaction. Let us know. We'll help you get to the bottom of it and get everything going. All right, next slide. We're going to talk about the best practices with working with lenders. We're going to talk about what mortgages, how they really work without getting way too granular, which if you feel like I might be getting a little bit granular, I apologize. I know I can do that sometimes. But let's see here. What we'll also talk about, and I apologize because my screen just went away. Um, Different types of loans, brief overview, and then Zareen's going to pop back in with contract addendums and provisions that are just what we're going to be talking about in terms of how to make mortgages work. So let's go into the next slide. It's just best practices when working with lenders. What we're really looking for here is the difference between pre-qualified and pre-approved. Technically, there is a big difference in Texas. Most other states, there's really not much of a difference. But in Texas, you technically may not use the word approved unless an underwriter has reviewed the file and issued a conditional approval. So when you see, if you're, for example, if you're representing a seller and somebody gives you a pre-qualification letter, just know that that doesn't have the same level of gravity, so to speak, as a pre-approval. Now there's also various stages of pre-approval, right? So that's, you always want to just pick up the phone and have the conversation with the loan officer, find out exactly um, what's the story on the loan? Hey, is this smooth? Is this rough? How's our debt ratio? Is everything in line? Has this been through automated underwriting yet? What we'll do, and this is, we're not unique, most lenders will do this, but they're going to fire the loan through the automated underwriting system. Typically, they're going to go ahead and get documents and review to make sure that the client makes what they say that they make. Analyze analyze information, um, run it through the automated underwriting system. That's really what you need for even the softest level of pre-approval, but definitely for a pre-qualification. Hypothetically, that's gone through a automated underwriting search. So automated underwriting for us, super easy. We click a button and then we know what to ask for. We already know what to ask for. But that is what the underwriter will use as the basis of their own underwriting. If you are representing a buyer, always include that pre-qualification or pre-approval letter. And what I always recommend, let the loan officer know that you're submitting an offer and to whom you're submitting that offer. Because for me personally, I love to pick up the phone, call the listing agent, and let them know, hey, we've got a great loan here. I'm representing the Johnsons. The Johnsons loan is just, I wish everything was as smooth as this in terms of the mortgage. Um, here's the strength, here's the strength. You'll note that we're putting down 10%. We actually could put down 30% if we really wanted to, give some talking points on the loan, and you know, why a listing agent should really consider this offer. Um, Part of
How
that
many of
is
you guys already do that? with the lender that you're working with, have them call the listing agent. It's a game changer if you're not doing that. I highly recommend it. I had one the other day where it was it's an investment property that we're selling, and I asked the agent if I could speak to the lender because they had put like 26 days for financing approval. And I was like, this doesn't even make sense. And he like wouldn't call me back, and it was really irritating. So I think the lender can make or break the deal.
And even if even if it is a smooth closing and you can say, hey, we're going to be getting the, the full approval here in 5 days or 10 days or whatever, having that introductory call and the relationship building is huge. Like Zareen said, I mean, most lenders don't even take the time to pick up the phone and call to make that introduction. And beyond that, if they're not making the call up front, they're probably not going to be making the call when something goes awry. Hey, the appraisal's been delayed, or hey, we're having issues with the debt ratio. If there's not that communication expectation up front, then lenders are going to wait until the last minute to tell you the bad news instead of keeping you updated. So definitely get that working relationship going. If you're a seller or representing a
Did you guys lose him?
Yes,
He froze.
All right.
got a frozen face.
Yeah, lost him.
Me too. Hey, John, will you text him and tell him that he's lost and he needs to come back? Or Vanessa, are you here? Can you pick up?
Yeah, sure.
Awesome. Hand off, baton pass.
Yeah, so I mean, to conclude this slide, it's very beneficial for the buyer rep and the seller rep to have a relationship with the lender on the transaction, and to request that communication to make sure everything's going smoothly. And that's something that we do without ask. So if you're working with us with a buyer who's pre-qualified and you've submitted an offer, we will definitely touch base with the selling agent if you would like us to, and just let them know how strong that file is, and that we can get it closed quickly and on time, and there won't be any issues with that. Is someone else clicking the next slide?
I'll click the next slide. I just want to make sure before we move on also that you guys understand the difference between pre-qualified and pre-approved, because that's a huge one. And if you're in in this crazy market, in some areas where it's very competitive and there are like multiple offers, if you can get your buyer totally pre-approved, you don't have to have a financing contingency on them getting approved, which removes one of the contingencies, which makes the sellers very happy. So that's a huge difference and a really smart thing to do if you have a very serious buyer who like wants their offer to be competitive and to win. Does that difference make sense?
Yeah, that's a great point. And something that I know a lot of buyers don't want to get their credit pulled or don't want to pull the trigger on doing a full pre-approval until they find a house, which that's their prerogative. We definitely would like them to get pre-approved before they start shopping. But if they don't, let's say that they've lost an offer, then at least at that point we have all their information on the application, and we can go ahead and put them in for a pre-approval. So on the next offer that they make, they're going to be fully pre-approved, and you can waive that contingency. So that's kind of how we adjust for buyers that haven't been pre-approved from the starting gate. So here's the mortgage process. Just a brief overview. We talked about starting with your pre-qualification. That's just gathering all the documents, running it through either automatic underwriting, or the next step would be actual live underwriting. And then at that point, they're ready to go. They've got a pre-qual letter or pre-approved letter, and they're shopping for a home. As soon as we get that contract, we're going to finish up setting the file and pushing it over to processing. And our processors are just going to make sure we have everything to meet the underwriting guidelines before it's submitted to underwriting. So any of the little items that they need to order for verifications on employment or some of the governmental regulations, tax certificates, things like that, they're going to order all that and then submit it to underwriting. Underwriting is going to take probably 2 to maximum 4 days if it's a jumbo. The underwriter is going to go through all the documents and guidelines to make sure that that file is ready to be fully approved and move on down the road. So then they will issue their conditional approval if it requires any additional documentation. So at that point, that's usually where we can waive the contingency. So this whole process up to this point hopefully goes really smooth, and it takes 5 to 7 business days max, and 7 being on like the jumbo, more complicated, maybe a self-employed buyer situation. But the easier W-2 files, good credit and everything, those should be really processed within a week. So at that point, they can feel confident that they can waive their finance contingency because we've got a conditional approval. And then it's just a matter of collecting those last few items that are on the conditions. And we work very close with the buyers to get those in quickly. And then we are shooting for a clear to close within a maximum of 7 to 10 business days. So then we're ready to close.
Awesome. Any questions about that, guys?
Okay. So these are the pieces of the pie when we talk about a file and the strength of the file. These are these are the items that we're looking for to make sure that we have a complete picture of the financial situation for the borrower. And these are the items that go into those debt ratios and loan to values and things like that that you hear on a regular basis. So income, we're looking at their type of income, their length of employment history, and verifying all those different documents. The assets, they range from liquid assets to stocks, bonds, the IRA or 401k accounts. All those things can be factored into assets that they can use for their down payment and cash to close. And that's a big thing that some borrowers don't always know the difference of between setting aside just a down payment, but also the full amount of the cash to close that's going to include their closing costs. So we definitely like to have a conversation and make sure they understand that there's additional costs beyond their down payment, so they're not surprised. And then it's got the give funds listed here, which is something they can use for down payment if they have gifts from their family. And then we actually have a new product that'll be coming out where you can actually crowdfund gift funds from friends and family, which is especially nice for first-time buyers and newlyweds and things like that. So that'll be something we dive into on another training about unique products that we have. And then we take a look at their liabilities, which part of it comes from their credit report, and then part of it comes from the questions that they answer on the application. So if there's anything that's not listed on the credit report, like child support, judgments, alimony, things like that, we'll get all that set up and included in the application. So we have a complete picture of what their debt to income ratio is. And then it's got collateral down here, which would be evidenced by the appraisal and just making sure the property's in good condition. And there's not going to be any lender required repairs like a bad roof or a really bad foundation, something like that.
That's awesome. So we have a question in the chat, which is they would love the slide to share with the clients. And Arlene, I think is it this 4 pieces of the mortgage puzzle or the mortgage process slide that you were talking about?
The mortgage process slide.
Okay, perfect. Yeah, you can share it with them. But again, I'm going to recommend like a personal conversation with Ashton or Vanessa or Michael is going to be 1,000 times more effective. But that's an interesting idea if you want like some type of collateral to share with your clients. That's definitely something that that they have to share with you? I know you guys have all sorts of marketing materials, so Ashton.
I have a, yeah, I
let's
have a
talk
new
about-
first time home buyer, and they're like, okay, now how do I get qualified? What do I do? How long does it take? What does my credit score have to be? So I definitely would love, you know, when the time's right to put them in touch. But I think that slide is just really helpful just to show them the step by step how it happens.
Yeah,
And
we're
What you
working
mentioned
on a-
about qualified versus approved, that I think is super helpful.
Yeah, we're working on a one page flyer that sort of puts together the mortgage process, like that one slide that kind of shows the processes and stages that they'll go through, and then a quick overview of the documentation they need to get their pre-qualification, which is really pretty simple, like the two pay stubs that cover 30 days of employment, 2 months of bank statements on their asset accounts that they're going to use for down payment and closing costs, and then 2 years of W-2s if they're a W-2 employee, or 2 years tax returns if they're self-employed. So kind of a one pager that'll kind of hopefully fit most of those details in. So as soon as we get that back from marketing, we'll get it over to you for sure.
Awesome. Awesome. Okay. So I think this was the next slide.
Okay, so debt to income ratio. Basically, there's a front-end ratio, which is just your monthly housing payment, including all of the components that go into what we call PITI, principal, interest, tax, and insurance. Also includes an HOA if that is applicable. Then the back-end ratio, meaning that is the total of your PITI and all of your monthly debts. So both of those items are considered when looking at which loan program you're going to qualify for. And down here we have a realistic view of the maximum ratios that you're allowed to have for each type of product. And you'll see these, if you were to Google DTI ratios and loans, you'll see all different numbers all over the internet. I don't know why, they're just not consistent, but this is what we really look at, and this is realistic. So you can kind of see when we talk about FHA being the most lenient of loans, easiest for first-time buyers, easiest for people who may have, you know, a little bit of a credit history issue. This has the most general DTI ratio limits. So conventional, you want a front end no more than 41. You can go up to 50% total. FHA, 47 on the front, a total of 57. And then USDA, a little bit harder, a little more stringent on the USDA. That's a zero down government loan for rural areas. And then VA is, it really just depends on the file. So it depends on the benefit that we get verified for the veteran's eligibility, and if they have additional reserves. So that one uses a much different, more complicated algorithm, if you will, to determine if they can, you know, cover that mortgage payment for the life of the loan.
And I also think this is something that as agents, you guys don't need to know too much about, but just understanding what the vocabulary is and the general terminology is a good idea. Any questions about it?
Do you have anything on the loan limits?
We're going to
We've got
cover
a
all the
slide that'll
specific
include
loans.
loan limits.
Okay, great,
Yeah.
thank you.
On
Did Ashton-
conventional, at least. It's not written in for the FHA. FHA loan limit this year is 530,200, 530,200. Conforming loan limit is 726,200. We'll see that included in a slide a little bit later.
I'll give it back to you, Ashton.
Okay. All right. Sorry about that. My either my internet or my computer or both were not cooperating. So we'll try again. So we are now looking at the slide that's, you know, what really makes up a credit score. I added this, it wasn't in our last version. So really and truly, FICO score is one of the biggest determining factors in qualifying for a mortgage. There are very different types of scoring models out there. Don't worry, there's not a test on this later, but the FICO 8 is the model that they use for mortgage transactions. It's very, very, very different than a consumer score, which is what folks will pull up on their phone. Typically, a consumer score weighs more heavily on revolving debt, and it's not really paying that much attention to installment debt. Whereas on the FICO 8 or the mortgage pull, the algorithms pay. They're looking at charge-offs. They're looking at everything derogatory. It's a totally different scoring model. Different loan programs have different requirements. We'll talk about that here in a minute as well. But the other important part about FICO scores is, especially on conventional loans, it is a huge driver on what affects the interest rate pricing. So we can go to the next slide real quick. So real quick, we're going to talk about interest rates and points. PAR is what folks typically reference when they're talking about what interest rate did you get or what were you offered. That is essentially a free interest rate. Up until, I would say, 9 months ago, you could get a PAR interest rate on pretty much everything. Now, with interest rates having increased so much so quickly, there may not be PAR options available if you've got a client with lower FICO scores. So they may have to pay points just to get in the door. That's not typically the case. Like I said, it's kind of a result of the market running wild. But typically in a normal market, you have a PAR rate, which is at no cost. You can take a higher rate and then get a lender credit back if you would prefer, if you've got a client that is maybe a first-time home buyer that is more worried about their cash to close. So they may want a lender credit and may be okay with taking a higher rate for a short period of time. And then conversely, you can pay discount points. One thing that we do when we're getting to know the client and do a home buyer consultation, get to know what their plan is for the future. It's not just this mortgage transaction. It's about, hey, what is your plan in the future? How long do you want to be in the home? Do you travel for work or do you move often? Are you going to be qualifying for the mortgage with fixed income? If you've got someone that's fixed income, perhaps a retiree, it might make more sense to spend more money on discount points to get a lower rate. If you've got someone that's a first-time home buyer that may not be in the home very long, it might make sense to get a lender credit. That's where really we sit down and consult with clients, learn about what their scenario is and kind of help consult them and make sure that they're getting the best product for them. If you go to the next slide, this is probably more than you're looking for, but this is what I like to let all of our clients leave a conversation with is walk out the door with this. This is just an example, but the 3 columns here, PAR interest rate, lender credit, discount points. It's a little bit blurry, but you can see that the rate in PAR is 7.25. With a lender credit, 7.5. With discount points, it's 7. The difference is the cost associated with those. So in column 1, which is the PAR rate, there's no credit, there's no points. With the lender credit, taking the higher rate, you're getting $4,000 back, 1%. In the discount point column, you're paying an extra $4,000 for the 7% rate. And you can show at the very bottom what the estimated cash to close is. So in this scenario, I just threw in rough estimates on numbers, but you really would focus here. If I was having a preliminary conversation with a client, this is the rate, this is the payment. Sometimes you don't want to focus too much on the rate because rates are kind of nebulous numbers anyway. You want to look at that total payment and what the estimated cash to close is. And we can kind of play around with numbers from there to determine how we get to an ideal payment and a good cash to close for The next slide is a little bit more in depth on, okay, you've decided you want to look at a par rate. Let's compare that to a 7% rate, a 6 3/4, and a 6.5 at the various costs for each of those rates. What I do when I'm analyzing this with clients, and again, not to go too granular here, but you take the upfront cost, divide it by your monthly savings. So each 1/4 of a point is going to be roughly $68 in terms of monthly savings. Divide that by the upfront cost. That's going to tell you your break even in months. So if you've got someone that you know is going to be moving in 3 years, none of these scenarios look good because the break even will take place after they're looking to sell or refinance their home. If you've got a retiree that's going to be in the home forever and doesn't plan on getting a mortgage again, then probably buy down number 3 looks best with the lower rate, even with the higher cost. We can go to the next slide. That's just something, again, when we get more into conversations with clients, they get to leave with that, mull it over, sleep on it, and reference back to it. So
Okay, Ashton, we probably have about 15 minutes to run through these mortgage loan types, okay?
perfect.
Cool.
So mortgage types, we can just jump right in here. We're looking at, and I might go ahead and go to the next slide, Zareen. You can skip this one. Conventional and conforming. Conventional conforming is the most popular option when people talk about mortgages having to put 20% down. This is what they're talking about, although you can get conventional with 3% down in some cases. If it's a first-time home buyer or if they're under the area median income limit. Typically, minimum down payments can be 5%, but we can help determine whether or not they're eligible for 3% down. You can get a conventional loan with a FICO score as low as a 620. I will say, though, that the interest rate pricing on those is really, really bad. So if you have a client that is in that range of FICO scores, probably under 700, they're probably going to do better with FHA unless they're putting a lot of money down. Seller credits between 3 and 9%. Let us know if you've got something coming with a seller credit or if you want to run by some scenarios. The seller credits vary based on the down payment amount. Mortgage insurance is required for less than 20% down. You can do monthly. We can structure it with a single premium. There's ways we can get creative about the mortgage insurance. These are guaranteed, technically not by the federal government, although Fannie and Freddie are in conservatorship. They're not directly backed by the government. Next slide, we'll talk about FHA. FHA is insured by HUD. And this is really a great option for first-time home buyers that may not have great credit. If there is a client that just doesn't have great FICO scores, or if their debt ratio is really high, like Vanessa was talking about, you can go to a 57 on these. These are probably the most forgiving loans out there, but they all have their own little wrinkles to them. The appraisal process is a little bit trickier. Sellers can chip in up to 6% towards closing costs. Maximum loan amount, like I said, $530,200 for FHA and DFW. Next slide just shows super quickly that most FHA buyers are in this sub 700 FICO range. Yeah, occasionally we'll see clients that have a FICO in the 700s or 750, 780, but their debt ratio is high and they may not qualify for a conventional loan. So usually when people think FHA, they think first-time home buyer, or they think more of a tough loan. And that's usually the case, although like you can see to the right, sometimes there's folks with sterling credit that still go FHA, and that might be because of their ratios. Next loan, VA. VAs are great for veterans, 0% down. They are not subject to the same loan limits. You can do a VA jumbo loan over 726,200. The only trick is based on the veteran's history and entitlement. They may or may not be required to make a down payment if their loan amount is over 726,200, or if they've had previous a home tied to their entitlement previously. We help walk through that. When we first get a pre-qualification, we're going to review, find out whether or not there's a client that has anything charged against their entitlement. We're going to find out if there's going to be a down payment requirement, all that fun stuff. FICO scores, really, I've gotten a VA loan to run in the low 500s. I've had a VA loan run through the automated system with debt ratios in the 70%. So VA is very, very forgiving in terms of their automated underwriting system. They don't even look at gross income. They really look more at net income and residual income. So just know that that's a little trickier as well. Underwriting's easier, appraisals are harder. Everybody has a kind of a seesaw effect, pro and con both ways. Next loan, I'm going to spend even less time on. It's the USDA loan. We don't do a ton of USDA loans. We have the ability to, but frankly, they're just due to various factors, the hard caps on the debt ratio and the fact that there's an income limit. It makes it really hard to fit buyers into a box of, well, they can't make too much money, but they have to have this amount of debt ratio. So we don't see a ton of USDA loans because of that. You'll see a slide, or at the bottom here, 97% of land in the US is eligible for USDA. Can't do it in the middle of the city, but a lot of the builders are finding tracts that are considered rural, and they're building new construction there. And it typically takes 5, 6, 7 years before USDA updates their census tracts. So if you've got clients that are purchasing, a newer home that a builder built, might still be eligible for USDA financing. We'll be happy to look at that for you as well. Okay, next slide. Jumbo loans, anything over 726,200, up quite a bit from last year. They change those every year. Typically it's in January. December is when we find out what the number's going to. Jumbo loans technically are considered non-qualified mortgages. They have different underwriting requirements. Typically those are small to mid-sized banks that offer them and hold those loans. And as a result, they're riskier, and because they're not backed by the government. So when interest rates have been kind of on this wild roller coaster, there have been jumbo lenders that have exited the market completely. There will be more lenders that exit the jumbo space with various changes that are coming up. Basel III Endgame being one of those to the marketplace. So just know that jumbos are volatile. Right now, jumbos have better pricing than 30-year fixed, conventional, but that's not always the case. Typically, jumbos have worse pricing. And also it depends on whether or not you're looking at a 30-year fixed, a 15-year fixed, a 7/6 arm, a 5/6 arm. We go through all those scenarios with clients as well to help figure out what they really need and what works best for them. Okay, Serene, you can go to the next slide. I added this, then I took it back out, but we can go over it super fast. Non-QM loans, these are the weird ones, the exotic loans. If you've got an investor that may not be able to show a bunch of cash flow, we've got a loan for it. It's called a DSCR loan. If you've got someone that is only going to be in their home for a year, maybe they want to consider an interest-only loan. You've got someone self-employed that doesn't fit into the guidelines of Fannie Mae or Freddie Mac or FHA VA's underwriting calculations, we can look at a bank statement loan. All these different types of loans are available. They have not great interest rates just because of the nature of the loan. Because the investor doesn't get to sell it on the secondary market to Fannie Freddie. It's not securitized by Fannie Freddie, or FHA or VA or USDA. So the risk all goes to the investor. So underwriting on these is harder, interest rates are higher, but there are avenues to help clients get loans still. I'll wrap up this piece with condos. We can go to the next slide. So you can do loans with condos. The big piece to note on condos is whether or not they are warrantable. A warrantable condo is a condo where Fannie Mae, Freddie Mac, FHA have reviewed the condo association's financials. They've reviewed, they've made sure that there's enough capital there, that in the event of massive repairs that need to be done, that the HOA in the condo is still going to be able to maintain profitability. They're not going to go under. Really what they're looking for is they want to make sure every 6 months you'll see something in the news where a parking garage collapsed in New York or something. They want to make sure that Fannie Mae and Freddie Mac don't have anything to do with those loans. There are avenues for non-warrantable condos. Those would fall under those non-qualified mortgages I was talking about. One piece that's here to note in non-warrantable condos, condotels. So for example, here in Fort Worth, we've got a couple condos that are above hotels. Because it's in the same building, those are non-warrantable condos. So you can't do a Fannie Mae, Freddie Mac, FHA loan on those. Yeah, that will go through kind of the crash course
So
on
when
this piece.
just
Go
to
ahead.
stick on condos for a second.
Mhm.
So if you guys are putting in an offer on a condo, you need to ask the listing agent if it's warrantable. And if you're the listing agent on a condo, you should know whether it's warrantable or not. And so connect with these guys so that they can help you figure that out. If you're scratching your head, you can always call previous listing agents in the development to see if there was financing and who did the loan. A lot of times, like certain lenders have figured it out, so they do a lot in a certain building. So just be smart if you're getting involved in a condo to know that this is an issue, whether you're on the listing side or the buy side. Any questions there?
One more piece I'll mention, you can do, and I've closed in the last 2 months, a FHA condo. FHA has a list of approved condos. If you've got a property that is not on that list, you can get a single unit exception. So there are steps that you can go through. Typically, you don't see a ton of FHA condos, but it is something that can be done. So.
Does anyone have any questions about like anything we've covered so far? It's a lot of information, but I think it's good information. Any questions? No, is anyone listening? Okay. So what we're gonna do now is we are going to go over some forms that you guys see frequently, like as they relate to financing, while we have these guys on the phone, so that if we have questions, we can bring it up to them. So the first one is obviously the third-party financing addendum. I'm trying to make this bigger so that I can read it. Can you guys read that now? Yeah.
Better.
Okay, good. So, this is a third-party financing addendum. You attach it if you are getting financing, whether there are contingencies or not. And that's, a lot of times people were like, well, this is basically cash because I'm getting a hard money loan or I'm getting a loan from whatever. I don't want to tell them that I'm getting a loan. Like they have altered the form. If you're using the latest version of the form, which is dated November 2022, anytime you're getting financing, you need to use this so that it's not an surprise when the appraiser calls, right? That's the worst. So we'll just walk through it. So you put the address of the property, And then the first paragraph 1 pertains to what type of financing are you applying for. Now, if you have a buyer who's trying to decide between conventional and FHA, I would check both boxes and fill both of them out, because then you're not presenting as if you're going to finance with conventional and then when switch to FHA and you have to like amend the contract, right, to preserve your contingency. So that's my recommendation. We rarely see one that has more than one, but if your buyer is considering, do both. And you should be talking to the lender. The lender is part of your team, right? Talking to the lender to figure out where they really stand. And then the lender is going to help you fill this out as well, because they're going to tell you how much are they financing, what type of loan are they getting, 30-year, 15-year, what's the rate, and then, how many points are we quoting them this rate. Usually you just put 1% there, but the lender may have like a different approach. So you should not be filling out these blanks without talking to the lender and just guessing. I had one the other day where they didn't want to put a number because they couldn't get a hold of the lender. And this was our listing. And I said, guys, that's a really bad sign. If the lender can't even answer that very easy to answer question. So it is non-responsive to the buyer's agent. So I said, you need to flesh that out a little bit. So any questions about this? There's conventional, there's a VA loan, there's FHA, and the typical type of loan is a 203B FHA loan. That's what goes in that blank, 203B. There is an FHA loan where it involves it's like a construction loan where they finance some of the improvements, and that's a 203K. But obviously a lender would tell you if that's what they were doing and you would know. So, these are the different, go ahead.
Hey, Zuri,
Yeah.
this Michael. Hey, the other day, John had one of the team members that started as conventional. Now they were pivoting to an FHA. Are you going to show the addendum?
I'm not going to show the addendum, but you do need an amendment to the contract changing this so that all of the contingencies are preserved.
Is there an addendum out there?
There's not an addendum specifically to that, but you amend the contract and you do it. I would amend the contract and do a new version of this.
A new version.
I would do it. Yeah. Or we can draft some language and to put in the amendment that says the buyer is, section 1A is being amended to include section 1C and then include this language. Does that make sense, guys? I don't want to be. Okay. So one thing I want to point out to you guys is that this paragraph G is new. And I say new, it was the November form that became required in, I think, February of this year. But basically, this covers the loan that I was talking about originally. If it's like a weird loan from your bank, a super non-traditional, or a line of credit, or like your parents are giving you a loan or something like that. And but where an appraiser might come. So you would say, the type of loan, the type of terms, and then you can see here, buyer does or does not waive all the rights to terminate under 2B. And if you check that they're waiving it, then you're removing the entire contingency around property approval, which is obviously what a seller wants to see. So you fill this out if you want to disclose, yes, we're getting financing. We don't want you to be alarmed when an appraiser calls, but please note, we are waiving all of our rights to terminate under 2B. Okay. So that's how you can basically present as a cash offer, because you're waiving rights here and you're saying it's not subject to buyer obtaining buyer approval. So it's basically, if you present it that way, it's as good as a cash offer, because you're saying we have financing, but there's no contingencies around this financing. Does that make sense?
Yes.
Okay, good. That's tricky and it's new. So, but I want you guys to know, because there's nothing that makes a listing agent and a seller more mad than getting the call from the appraisal when it was presented as cash, right? So don't do that.
Zareen, with this, would you then not do the amendment for waiving the appraisal?
That's right. Yeah, because
Okay.
this, if you check this does waive box right here, the appraisal is in that and you're already waiving it.
Okay.
So not necessary. And if someone doesn't understand that, you kind of need to tell them to talk to their manager or talk them through it. Or I am, of course, always happy to talk through it with anyone. Okay. So paragraph 1 is all about the type of financing. Paragraph 2 is about, yes.
I'm sorry, I had a question about if you put in on the interest rate not to exceed 7.25 or whatever, and when they go to lock in their rate or whatever, it actually does exceed. Does that mean that they have an out on on the contract?
You know, I mean, this is a tricky one, and I kind of get asked this. I've never seen someone terminate for that reason, right? But I would say if they got there, you're saying, I want a loan a rate that's at least this much. So if you can't get it, then you just say, well, I can't qualify, right? And it's, you qualify within you terminate within the number of days in 2A and you're fine. I've never seen that. Arguably, yes. I haven't seen it done.
Okay.
Does that make sense?
Yeah, I was just curious if that could be an out for.
Yeah, I know agents get really, really stuck on that. And actually, that's a question for the lender. So what goes into that interest rate number, right? Part of it is the individual themselves, correct? So like, if Emily and I apply for the exact same property and the exact same loan, like my rate might be worse than her rate if she's in a financially better situation than me, right? So I would argue that would go under 2A. And I'd be curious what John or Vanessa, or Ashton or Michael would say. Anyone?
And then the nice thing about that it does include points in that paragraph. So when you compare both together as one entity, if you will, you know, if they had their heart set on a max rate at a max cost, and all of a sudden things shoot up or something goes a different direction, they can't get that. I would say that they had an out, but I would definitely try to do it within your contingency period so that you're not, you know, just.
Yeah, and I think that's what, if you see, you know, an interest rate not to exceed 2% with 0 points, then you're like, this is not a legitimate offer. This buyer hasn't talked to a lender, you know, or they're stretching, they're not likely to get that. So it's going to be easier for them to terminate. So I think you just have to be mindful. I think it's tricky and it's a little bit gray. And I've never actually seen someone use that as the reason. They're usually just saying like, this is what we're trying to get. If we don't get it, you know, we're not going to qualify. Does that make sense?
Yes, thank you.
Okay, kind of ish, not really, but it's confusing. Okay, so 2, like I said, 2 is where the contingencies are included, and you can see time is of the essence, which means you have to strictly comply to the dates. So there's 2 different contingencies, I always say, in this addendum. 2A relates to the buyer, and that's the one where you have a certain number of days. And that's the example I was giving where I had this rental property listing and they had like 26 days in this blank. I'm like, there's no reason it should take someone 26 days if they are remotely organized with their loan. So that seems like a very easy out. And I also want to get to day 25 of the contract and closings in 1 week, and they terminate because they didn't qualify. So I connected with the lender, and, you know, like I said, he was difficult to reach and it was annoying, and we reduced the number of days. But that's the number of days that the buyer has to qualify. 2B is,
Zreen, can I
yeah,
ask a question? What is realistic on buyer approval on the days? Because I mean, I see everything from 5 to 10 to, I mean, you know, for a
well, I
lender.
would say it depends on how far along in the loan process is the buyer. I mean, if you check this box, the contract is not subject to buyer obtaining approval, is because they've already done all of that legwork up front. If you've done 90% of the legwork back and forth at the lender may say, look, I need 5 more days, and we're good to go. But the lender may say, this buyer is really slow and they're non-responsive, and so I'm going to say 21 days. You know, so it really depends on the quality of the buyer, getting them the documents. It depends how far they're into the process, and it depends how quick the lender can do it. So I don't know, Vanessa or Ashton or Michael, if you guys have feedback about if you had like a totally on the ball buyer who wasn't like self-employed in a total mess, like what's the quickest amount of time you could say if you were just getting started the day the offer was written?
It goes back to whether or not they're pre-qualified or pre-approved. So if they're pre-approved and they've been through underwriting, they have that conditional approval. It's just a matter of getting the final documents in and getting an appraisal. So it could be, you know.
Well, the appraisals has nothing to do with it. It's just for the buyer qualifying.
Yeah, but to get our clear to close. So if you wanted.
But this date is not for clear to close. It's just to get the individual buyer approved.
Yeah, I would say between 5 and 10 days, maybe 2 weeks. But I mean, you're really, look, if they're already pre-approved, then
Well, I mean, if
depending
they're
on the level
pre-approved,
of
in theory, you're checking
pre-approval,
this box,
yeah.
right?
Well, it depends. There's, like I said, there's different levels of pre-approval. If it's been through and it's conditionally approved, think about a conditional approval, like a checklist.
Right.
There could be 50 things on the checklist,
Mhm.
or there could be 2. So that conditional approval, this is where you really want to speak with the lender and say, hey, I saw that this was pre-approved. How many conditions are left? And how many of those pertain to the buyer? Because obviously some of those conditions will relate to the appraisal. We're not worried about those.
Again, that
But
does
if
not
this
have to
is-
do with
yeah,
this
exactly.
timeline.
Yeah, exactly. We're not worried about those. So if we're saying, hey, there's 5 conditions, okay, we should have those back and we should be done in 5 days.
Assuming the
If
buyer
there's-
is responsive, right, and gets them what
Right.
they need.
Yeah. If
So I think
if it's a pre-qualification and it hasn't been through underwriting yet, I mean, 10 days, 2 weeks.
Yeah, I mean, I think
Okay.
if you get a number, you have to talk to the lender, right? And if you're really a diligent listing agent, you want to talk to the lender to get the full story and to see if they seem like they know what they're doing. If you, like I said, when I saw 26, I was like, that's insane. That's just too long for someone that knows what they're doing and for a buyer who's remotely communicative, in my opinion. I was like, no. So they came back and said 16. And I thought 16 was long and annoying if supposedly they've already been talking to this lender, but I agreed to it and it came and went and it was fine. So it's really a function of, but don't put 2 days because no lender is going to be able to do that. So you need to talk to the lender. 10 is probably a reasonable, quick amount of days, 10 to 14. Might be
Okay.
less, might be more, depending on the circumstances, I guess is the rule of thumb.
Okay,
Okay, sorry, that was a lot.
that's okay. That
okay.
you clarified a lot though, because I mean, most buyers, they're gonna have to go through underwriting. They have not done that yet. I mean, the ones I'm dealing with anyway. So,
Yeah, that's right. So that's the amount of time that you stick into this that is negotiable. Totally unrelated to that with respect to the second contingency is the property itself qualifying, which means it has to be insurable. The roof has to be insurable. It has to appraise. They have to review the HOA documents, right? The underwriter's going to have requirements around all of those things. And that right to terminate goes away no later than 3 days before closing. So, and in this case, if you terminate because of the buyer didn't qualify within this number of days, you just have to let them know. And because of RESPA, you don't really have to say why. So it's a pretty open-ended out. In this case, if you're terminating under 2B because this number of days has passed, you're going to have to explain why, and the lender has to give a written statement. So you can't just make it up then. Good questions there? Arlene says she has a buyer who's getting financing through a trust. What would I check off? I mean, if it's their own money and it's just coming from a trust and there's not going to be an appraisal and it's not really a loan, then you don't have to do anything. If there's going to be a loan and there's an appraisal, then you need to check other financing. So, okay, we're going to keep moving. So here, in this blank, you're going to put the sales price for FHA. And then down here, you can just see that this gives you as the listing agent the right to talk to the buyer's lender, which is nice. It says buyer authorizes buyer's lender to furnish to seller or buyer or their representatives information relating to the status of the approval of financing. So you do have the authority to talk to them in the contract. Okay, we're going to move on because we have a few forms to cover and we have 4 minutes, but this is the addendum concerning right to terminate due to lender's appraisal. We've talked about this document a lot. You can only use it with conventional financing. You cannot use it with FHA or VA. We do have language you can write in those circumstances, but it's probably not enforceable, but people want it. So we have it. So there's 3 different options here. And the first one is the one that the seller wants to see, which is like, it's a total waiver. Like, we don't care what it appraises for. We're paying for it no matter what. If it's $1 million property and it appraises only for 800, your buyer is saying, I can make up that $200,000 difference, right? And get my financing as if the property were only $800,000 worth of value. So before you do that, you need to talk to the buyer's lender and make sure that they're not that it's not something that they think that they can financially afford, that they can't actually financially afford. Then the partial waiver, that's the one, of course, the seller wants to see is a full waiver. A partial waiver says, we're waiving our right to terminate as long as it appraises for this much. So say you have a property that's listed at $1 million and you offer, 1.2, you want it to appraise for at least 1.1 before, or you want the right to terminate. And that's where you put this in here. Does that make sense? Okay. Or you want it to appraise for at least 900, right? Like you're waiving the appraisal in the contract, which says it has to appraise for at least the purchase price. So then the last one, and this is the unique situation but you need to know that it exists. It's a situation where your buyer is getting financing, but they're going to put so much money down and be so well secured that the lender's not going to care if it appraises or not, because they know that they're making a healthy, safe loan. So if in our $1 million example, if the buyer's like, I'm going to finance, 500 and I'm going to put 500 cash down, and their loan to value is 88, 80-20, the lender doesn't care if the property doesn't appraise, because they're going to be well secured. But the buyer may say, I don't want to put 500,000 in cash to the property unless it appraises for at least 750. Right. So that's that situation where the lender doesn't care what it appraises for, but the buyer does, because they're putting so much cash down. Okay, good. Any questions there? It's 10:58. Let me take a pause and just show you guys. This is the list of people who I have CE credit for. If your name is not on this list, please write your name and license number in the chat now. Okay, and if you need to go, it's 11, so go. We have, I think, repairs to talk through. We have 2 more, we'll probably be here for 5 more minutes, but you're welcome to go if you need to go. Thanks for coming, guys. Okay, so this is the paragraph in the 1 to 4 that pertains to lender required repairs, and it changed last year also. So I just want to point out the changes. First of all, this says, if there are lender required repairs, neither party is required to make them to get the deal done. And then, the property obviously wouldn't be approved under 2B, and the buyer could terminate. But the buyer could make them if the seller says no, and the seller could make them if they want to, but neither party has to. This was what this says. It also says if they're in a circumstance where the cost of the lender required repairs exceeds 5% of the sales price, even if the seller is willing to do it, the buyer may say, no, thank you. I don't want a property that needs so many repairs. So that's what that 7E says. And now 7F talks about repairs and treatments and how they should be done. And basically, unless otherwise agreed in writing, seller will complete all repairs prior to the closing date and will obtain permits. And then this is where it says repairs and treatments must be performed by people who are licensed, or if there's no license, are commercially engaged in the trade of providing such repairs. So basically that means you cannot, roll your sleeves up and go out there and try to fix the sprinkler system. You have to hire someone. And if you don't need a license to fix sprinklers in Texas, you still have to hire a commercial sprinkler company. So that's what that says. You do not need to write in your amendments, licensed plumber should do this. It's in here, right? So that's one thing that agents always get confused on. The second, and this is the change, and I think it's really valuable. It's something that you guys as really good agents were already doing. But it's not something that necessarily other agents were doing. And it's super helpful for you guys to have it in the contracts, because now you can point to the fact that if you agree to repairs, then seller will provide buyers with copies of documentations from the repair person showing the scope of work and payment for the work completed. And then also will arrange for the transfer of any warranty. So that's in the contract now. I think good agents used to already do that, but now it's required that they give you invoices showing the scope of the work that was paid for, so that if there is a problem after closing, you can go back to that vendor and say, so-and-so paid you this much to do this work and it's broken again, right? And it's also just proof that the seller did it. You don't have to necessarily re-inspect, although you definitely could. So, and of course, if seller fails to complete any repairs prior to the closing, the buyer can, it's default, buyer can exercise their remedies. Okay, questions? Okay, so this is, do they have to show you receipts for leases for any repairs that were to be done? I don't think that's in the lease, Arlene, to be honest. I know that there's a section in the lease says that the landlord will do X, Y, and Z, but the lease form that we use is very landlord friendly, so it does not require that. That language I just showed you is from the 1 to 4. Okay, so 12A1B is this is 12 relates to settlement and closing costs and how they're going to be divided. And section 12A1B is the amount that the seller will pay on behalf of the buyer. So this is if you do your inspection and you say like you upload it into punch list, which is now BossCat, and they give you estimates, and you're like, they could either repair the HVAC and the plumbing, or I have an itemized, estimate from BossCat that says it will be $3,700 worth of work. I'm just going to ask them for $3,700 of closing costs so that I can go and hire my own contractors to do it after closing. Does that make sense? And there's a spot in the amendment form that just says section 12A1B is changed to, where instead of negotiating repairs, you're just negotiating a dollar amount so that the buyer can go do the repairs themselves, basically. But this is part of this class because there is a limit on what buyers can have paid for by sellers. So don't just write a number in here, because say you negotiate for $20,000 worth of repairs and then you find out that the buyer only has available $16,000 worth of closing costs to be paid for, that you don't get the benefit of that $4,000 that you negotiated for. So the lender can calculate pretty much down to the dollar what this number would be for the buyer's loan. So don't write a number into this blank without talking to the lender. Questions? I think for conventional, it's around 3% is a good estimate, but again, don't write a big number in there without talking to the lender.
It varies based on the loan amount on conventional. So 3% for less than 10% down, 10% down to 30% down, you get 6%. Over 30% down, you can get up to 9%.
Okay, perfect. So Ashton and Vanessa and Michael can calculate it for you, but don't just guess. Don't walk away from this class thinking 9%, because that's not good. You'll be in trouble. You'll negotiate and not get the value of it. So, okay, the last document is the non-realty items addendum. And we include this because if you're in a situation where the buyer is buying a lot of the seller's furnishings or equipments, you really want this to be separate from the contract, because the lender doesn't want to think that they're financing for real property, something that's actually for the value of non-real property, right? It's $1 million sale, but you're buying, the boat and the Ranger and the whatever. They don't want to, and it's all included, and there's not a separate dollar amount that the buyer's going to be paying the seller. So what I recommend you do is you can still fill this out as part of the contract, but then have a bill of sale prepared by the title company that's like a separate amount. Because this happens. Has anyone ever done a deal like this where you're negotiating for like big ticket personal property? The takeaway here should be keep it out of the contract. Don't submit it to the lender. And then this number needs to be a really nominal number if you are going to include it like with what gets sent to the lender. Does that make sense? Lenders, do you have anything to share about that? No? Am I frozen?
I've had some
You're correct.
say that they don't like it if you put 0, and then I've had some say you have to put $1. So I've kind of had that been told to me.
Yeah, I think, in Texas, there's this idea of consideration and you have to have a benefit of the bargain. So putting 0, it's like, okay, well, then they're just giving them that. That doesn't make sense. And that's not legally binding. So they would say put a nominal amount like $5 or $1 or $10, but don't put, once it gets substantial, lenders don't like to see that. So I would just, if it's getting substantial, reach out to me and the title company, and we can help you handle it kind of outside of the contract. Good?
Yes.
Okay. All righty. Well, that's all we got. And does anyone have questions? Thanks for hanging in there.